Okay. Good morning, everyone. It feels like a long time since we've been together. It has been. So today what we're going to be doing is we are going to be covering Chapter 10. Chapter 10, short chapter. All the rest of the chapters from here on out are pretty short, and they're kind of standalone, so they don't really build on each other. What to do this week: Attendance Quiz 22 covers class today and Wednesday. Chapter 10 homework, we will finish anything to do with Chapter 10 homework today. I will say that a bunch of the Chapter 10 homeworks were in the videos that would have been due, the video quiz that was due last night. In those videos, a bunch of the homework is. So we have 1 or 2 homework problems to do today. And then Sunday, video quiz 23, that is over chapters 11 and 12 in the Blackboard videos. 11 and 12 we're going to do Wednesday this week and Monday next week. Okay. There is a handout for today. If you're just walking in, the handout is on the table as you come in the door. If you're online, you should have gotten it pushed out to you when you log in. And you can also access it from this URL if you're watching this later, http://tiny.cc/ch10small. So what all the handout is today is, again, to ease your writing. It's the questions we're going to be doing today. So I just wanted to make that so we wouldn't have quite as much writing to do. We have a lot of questions. So if you didn't get the handout, if that's not pushing out, you can also type in the URL. Haley will put the URL in the window that you can grab it that way as well. Haley, you can try re-pushing it out too. That might be good. Do both. Okay. Okay, again, if you're walking in, there's a handout up at the table in the middle, the back, of the front. Okay. Can you? Okay. Okay. So with that little housekeeping detail out of the way, we're going to get started. Okay, there are 4 learning objectives in Chapter 10. Chapter 10, first of all, the features of a corporation, so that's something you would read and certainly want to make note of. Issuing stock, which is when a company issues its own stock to raise cash. Learning objective 3 is treasury stock, when a company goes out and buys its own stock back. And then learning objective 4 is talking about retained earnings, dividends, and dividend splits. Okay, so a lot of these questions would have come from the videos that were due last night, so we just want to dive in. Slide 2 on your handout, I've labeled them in the lower right-hand corner. They're kind of, I guess I did a vertical layout instead of horizontal when I printed them. You know that PowerPoint option? Well, it was vertical. That's why they go down. So the purchase of treasury stock by a corporation increases total assets and stockholders' equity. True or false? I'm waiting to see what you marked down. What do you think? Okay. I'm going to stay right here. I'll be back. What do you think? True? Okay. What do you think? Okay. Okay, you know it's on this handout. If you flip it over, that's why. You think it's false? Okay. Okay, change your answer. False. Okay.
Oh, I already know the question.
Yeah. Wow. What do you think? False. 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 Okay. Okay. Now, I was getting a bunch of trues at first, and then it seemed to change, the tide seemed to change to false. What do you think? I'm back. Okay, let's just talk through this. When we purchase anything, what are we paying for? What are we paying with it, for it? What are we using to pay for it? Cash. What's happening to cash if we purchase something? It's going down. If cash goes down, what's the impact on total assets? Goes down. So this statement, just partially, would this increase assets? No, it would have to decrease assets, right? So we know it's false, so it is indeed false. But it's false because when we purchase Treasury stock, we're going to decrease cash, and Treasury stock is buying our own stock back. So we're going to, this journal entry, when we look at what we're doing here, the journal entry here would be to credit cash. The second line is credit cash. The first line is to debit Treasury stock. Treasury stock is like a contra stockholders equity account. Stockholders equity has a normal credit balance. And if we're debiting it, we're reducing stockholders equity. If we're buying our own stock back, we're reducing stockholders equity. Okay, so this is false because it actually decreases total assets and decreases stockholders' equity. So it's the exact opposite of what it says. So if it had said the purchase of Treasury stock by a corporation decreases total assets and stockholders' equity, that would have been true. So the word that makes it false is increases. Okay, next one. The purchase of Treasury stock has the same effect as issuing stock. True or false? What do you think? False? Okay. False. Okay, we have this group up here saying false. Okay, I think that's probably a good answer. When we purchase Treasury stock, we're reducing stockholders' equity. When we issue stock, we're increasing stockholders' equity. So they're actually two transactions that are exactly opposite of each other. So this one is false. Okay. Okay. Treasury stock is a contra stockholders equity account. True or false? It is true, yes. Okay, short exercise 1010. Okay, I think one homework problem was in the video, but I'm doing it over. This might be one. I'm just doing it to emphasize it. So there is one that will be duplicated from the videos, Chapter 10 videos. Okay, so we have exercise 1010. So it's not on your handout. This is in your book. Reported the following stockholders' equity, so it gives us a list of stockholders' equity. Do want to point out, see how Treasury stock has brackets around it? It's because it's a contra stockholders equity account. It reduces stockholders equity. It's our own stock. We've gone out to the market and purchased our own stock back, reducing the amount of stockholders equity. So it says during the year, they purchased Treasury stock at a cost of $22 million and resold Treasury stock for $15 million. It had cost them $4 million. Record the purchase and resale, and then how much did stockholders equity increase or decrease? So first thing we're going to do purchase Treasury stock. If we purchase Treasury stock, we alluded to this earlier with the first multiple choice or first question, second question. If we purchase Treasury stock, we're spending cash and getting Treasury stock. So that journal entry is going to debit Treasury stock, which is a stockholders equity contra account, and it's going to credit cash. Okay, this transaction, we're debiting Treasury stock. We're reducing the amount of stockholders' equity. with that, we're also reducing cash, which is an asset. So we're reducing stockholders' equity, reducing total assets with this transaction. So then we move on. We resold the Treasury stock for $15 million, and it had cost them $4 million. Okay, so now we're doing the sale of the Treasury stock. First thing, in that transaction, how much cash am I getting? I'm getting $15 million, right? So we know we're going to have a debit to cash for $15 million. So no matter what, we know we can get that right. So then our credit, what are we doing with the credit or credits? And that's where we're going to credit Treasury stock for the original cost. So you do want to make a note next to where it says Treasury stock there. When we sell the Treasury stock, we credit it for its original cost, so what it cost us when we bought it. And then the other journal entry is the other credit to make this balance, because we got cash of $15 million. We bought it for $4 million, so that $11 million is going to go to an account called paid in capital. If you want to abbreviate it, paid in capital will work fine. Okay, so now moving on. So we've done the purchase of their Treasury stock, we've done the resale of the Treasury stock, and now we're asking how much did stockholders' equity increase or decrease as a result of the two Treasury stock transactions? So we're looking for the overall impact of stockholders' equity increase or decrease. So we purchased Treasury stock for $22 million. That would be a decrease in stockholders' equity. If we purchase Treasury stock, it decreases it. When we sold it, we got 15 received. Okay, so the overall answer is Treasury stock decreased by 7. Stockholders' equity. Okay. Okay, next question. Casey's Computers purchased 4,000 shares of its own $10 par value common stock for $92,000. As a result of this transaction, what happened? What do you think? C? C, okay. A, okay. What do you think? C? C? Getting outnumbered here. We'll see. Okay. Okay, and it is indeed C. It's C because when we purchase our own Treasury stock back, the amount of the purchase is going to reduce our stockholders' equity. Okay, so this is one of those things. If we purchased our own common stock, $92,000, that's a Treasury stock purchase, it's going to reduce stockholders' equity by $92,000. We don't know what we originally sold it for. We don't care. We just know that we spent $92,000. It reduced stockholders' equity by the $92,000. Okay. Okay. If Treasury stock is sold at a price greater than its reacquisition cost, so we're selling it at a price greater than what we paid for it. So we went out and bought our own stock. Now we're holding it, and now we're going to sell it. So when we go to sell it, we're selling it for more than what we paid for it. The difference is what? A, debited to paid in capital. B, credited to paid in capital. C, debited to retained earnings. Or D, credited to retained earnings. Okay. Yeah, that's okay. Hard to get back into the flow of things. And this isn't the most intuitive topic either. B, okay, credited. If we sell it, and this goes back to that entry that we made in short exercise 1010, where they sold that second entry we did where we sold the Treasury stock at a price greater than what we paid for it, that's what's happening here is we are crediting to paid-in capital. That exercise 1010, the reason I wanted to do it is it does show the two entries that you would most commonly see with Treasury stock, the purchase of Treasury stock and the subsequent resale of Treasury stock. So those two, what I'm trying to say between the lines is you should know those two entries that were in 1010. Those are good entries to know, to write down as reference. Okay, now 1012. Okay, got it. Okay, Greenwood Corporation earned net income of $85,000 during the year, and on December 15th, they declared a cash dividend on its 8% preferred stock, which was 20,000 shares with total par value of $200,000, and a 15-cent per share cash dividend on common stock. So it gives us all those details. So they declared the dividend. So they earned net income during the year. On December 15th, they declared the dividend, and they paid the dividend January 4th. This is very common. Until the date of declaration, the company does not have any obligation to pay dividends. A company does not have a legal liability to pay dividends until they actually declare it. So in this example, the declaration date is December 15th. On that day, they have a liability to pay it. And then they also have two other dates. One date is date of record. And we're not told the date of record in this one because we don't particularly need it. But typically when a company declares a dividend, they'll say that everyone, in this case, the date of record could very well be December 30th. They could say on December 15th that everyone that owns this stock as of December 30th gets the dividend, is entitled to the dividend. That's the date of record. And again, we're not given the date of record here because we don't particularly need it. But then they all go on to tell us that the dividend payment date is January 4th. So December 15th, they create the liability. They pay off the liability on January 4th, but in between there, they have financial statements to issue. So that they need to record the dividend liability. So we've got A, declare the cash dividends on December 15th, and B, pay the cash dividends on January 4th. So the first one, declaring the cash dividends on December 15th, okay, what we're going to be doing there is we need to calculate how much cash dividends, what's our liability, what did they just declare? Okay. Well, they declared two dividends, two parts of dividends. The first one is the $200,000 par value on the preferred stock times 8%. Okay, preferred stock pays a percentage. So the 8% times the $200,000 total par value that they gave us up in the problem. And then we also are paying dividends on the common. The common is 15 cents a share. So we take 15 cents times 40,000 shares. So note that that's different. The preferred stock pays a percentage of par value. Common stock pays a certain amount per share. So they're calculated differently, but to get our total liability, we add those two together. So we're going to be debiting retained earnings and crediting dividends payable for the amount of those dividends. Okay, so what's happening here? Retained earnings is stockholders' equity accounts. Stockholders' equity accounts decrease with debits, increase with credit. Stockholders' equity has a normal credit balance. So if we're debiting retained earnings, we're pulling it out of retained earnings is what's happening here. So we're decreasing stockholders' equity and we're increasing liabilities with this transaction. So that's entry A on December 15th. Okay, on January 4th, we're going to pay this dividend. So the entry there, we're going to pay the dividend. The dividend is $22,000. So we're paying the dividend. We're paying it with cash. So I always like to tackle which side is easier, and cash is easier. So I'm going to credit cash for the $22,000, and then I'm going to debit something for $22,000, and that something is going to be to remove that liability. So we're going to debit dividends payable and credit cash. Okay, and then the final question is, did retained earnings increase or decrease during 2012? Okay, during 2012, so those are the two entries we made. During 2012, retained earnings would have decreased by $22,000. Okay, but we also had income of $85,000. See where I've circled it up at the top? So retained earnings, they're not saying did retained earnings decrease from this transaction. It's saying during the year, what happened to retained earnings? Well, back at the beginning of the question, so I've circled it, second line of the problem itself, we had income of $85,000, and then we would have had this retained earnings reduction of $22,000, dividends reduced retained earnings. So overall, we would see net income of $85,000 less the $22,000 for dividends gives us a net $63,000 increase in retained earnings. Okay, this was a sleeper question, so you need to make sure that when you read the question, did retained earnings increase or decrease during 2012, that's not just this transaction, that we had to go back and get that net income from the problem. So net income increases retained earnings, dividends decrease retained earnings. Okay, next question. I think we're going to do a bunch of them here in a row. Okay, 7, upper right-hand corner. A debit balance in retained earnings indicates that a company's lifetime earnings exceeded its lifetime losses and dividends issued. True or false? I'm going to answer the question in the window. I'm just going to address it. In the question in the window, I'm going to go back for a minute. We'll come back to this. Okay, question. If we're subtracting dividends, why is it considered an increase of retained earnings? Okay, dividends do decrease retained earnings. You are absolutely right, Samantha, that dividends decrease retained earnings. But the question is, did retained earnings increase or decrease during 2012 in general for everything? Well, in 2012, we had net income of $85,000. That would have increased retained earnings. So we had an increase of $85,000. We had a decrease of $22,000 for the dividends. So the net difference is a increase in retained earnings of $63,000, but you are right, the dividends did decrease retained earnings, but we had an increase in retained earnings for the net income. Okay, so back to our question. Hope that answered that. If not, Haley will follow up with you. Okay, a debit balance in retained earnings indicates that the company's lifetime earnings exceeded its lifetime losses and dividends issued. True or false? True or false? False. And this is false, you're right. And the reason this is false, let's make some notes on this question. A debit balance, if you have a debit balance in retained earnings, debit balance should scream to you immediately, that is a loss. Retained earnings has a normal credit balance. So in normal life, if a company is going along healthily and has some earnings and things like that, it will have a credit balance. A debit balance of retained earnings means that they have a cumulative loss over time. So debit balance is a red flag. Normal balance of retained earnings is a credit balance, so debit means we have a cumulative loss. And then so the rest of the question says a company's lifetime earnings exceeded its lifetime losses and dividends. So retained earnings increases or is credited with earnings. Okay, so our credits to retained earnings are from net income. Our debits to retained earnings are losses and dividends issued. So if our lifetime earnings exceed our losses and dividends, we will have a credit balance of retained earnings. So this is false. It would need to be a credit balance in retained earnings for this question to be true. Okay. Okay. Haley, you'll deal with it. Okay. 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 Now, this is going now into stock splits. So total stockholders' equity remains the same before and after a stock split. True or false? Samantha, Haley's going to get back to you, but we've got somebody working on the computer in here right now. False? Okay. Okay. Coming over here. Let me see. Okay. Okay. True? You sound pretty confident. What were you thinking, true? Yes. Okay. 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 Well, it's a good thought. Okay. So on this, this actually is true. Okay. And let's talk about the reason why. A stock split simply means a company is dividing everything. Wow. Hold on, I'm getting back to where. Okay, so we're still on slide 8. Sorry that. Okay, the total stockholder equity remains the same before and after a stock split. When we have a stock split, all we're doing is saying our stock is priced too high. The theory used to be that if a stock was priced more than $1,000, it would reduce its marketability because investors wanted to buy it in smaller chunks. So the thinking used to be, well, as soon as our stock gets to 1,000, or companies would have different benchmarks, then they would say, oh, if our stock previously had a $10 par value, and say we had 1,000 shares outstanding and a $10 par value. A stock split, all we're going to do is say, wow, we now have 2,000 shares outstanding, par value is now $5. So we split the par value in half and issue twice as many shares of stock. A stock split is simply a bookkeeping entry. It doesn't change anything overall. Apple has split its stock several times. McDonald's, if McDonald's had never split its stock, McDonald's, a single share of McDonald's stock would be over $10,000 right now. So you think to yourself, how many investors would say, I want 2 shares of stock and it's $10,000 a share? So that just feels unwieldy. So the thinking a long time was you had to split your stock when the stock price got a certain price so that it would remain marketable. Because once you split your stock, it just cuts everything in half. So if I'm a shareholder and I have 500 shares of stock and a company does a stock split, I then have 1,000 shares of stock, but each share is worth half as what it was before. So stock splits do not impact total stockholders' equity. Okay? Well, we'll just skip to the answer on this one. The effect of the declaration of a cash dividend is when we declare a cash dividend, that was in the homework problem that we just did. When we declare a cash dividend, we're going to be reducing retained earnings with a debit, and we're going to be crediting dividends payable. So the credit to dividends payable is where that increase to liabilities comes from, and the debit to retained earnings is where that decrease to stockholders' equity comes from. Again, the two homework problems we've done, 1012 and 1010, both have really good examples of the journal entries you need to take away from this chapter. Okay, next one. The date when a cash dividend becomes a legal obligation is on which date? The date of record, the declaration date, the last day of the corporate year, or the payment date? B. Okay, the date when a cash dividend becomes a legal obligation, and the answer is indeed B, declaration date. Okay, next one. If a corporation declares a $10,000 cash dividend, the account to be debited on the date of declaration. So remember when I said those journal entries from those two homework problems are critical? This is another one that you can answer looking at the homework problem that we just did. So we declare a $100,000 cash dividend, the account to be debited on the date of declaration. So when we declare a dividend, when the board of directors says, oh, we have this dividend, what account are we going to debit? C, retained earnings. Yes. Yes, and that is C, retained earnings. So those journal entries in 1010 and 1012 are great. It's retained earnings. Yeah. Okay. So okay. So do you know the two screens don't match? Not a big deal. Not a big deal. Really? When preferred stock is cumulative, preferred dividends not paid in a year are, okay, so we're talking about preferred stock. This is an actual characteristic of preferred stock. So when it's cumulative, preferred dividends not paid in a given year are A, distributions of earnings, B, called dividends in arrears, C, a liability, and D, never paid to the preferred stockholders. Okay, on this question, and this is another thing, it's a good thing to know the characteristics of preferred stock, and one of the major characteristics of preferred stock is cumulative. Preferred stock is assumed to be cumulative unless it tells you it's not cumulative. Cumulative is the reason that preferred stock gets its name preferred. Now when we talk about preferred stock, we said when we calculate preferred stock dividends, they get a percentage of par value. So their dividend will never change. They will always get whatever percentage of the par value. So if the company has a really great year, they don't participate in any earnings. But if the company has a bad year, they still don't have to be paid their dividends. But if the preferred stock is cumulative, that says before the company can ever pay any dividends again to common shareholders, they have to pay all these back dividends. So if preferred stock is cumulative, preferred dividends not paid in a given year are called dividends in arrears. Dividends in arrears are all these back dividends on preferred stock that have not been paid. Dividends in arrears is not a liability. It is not recorded. The company knows it's there. Now dividends, preferred stock dividends, just like common stock dividends, are never a liability until they're declared. A company never, ever, ever has to pay a dividend. Until it declares a dividend, it does not have a liability to pay a dividend. But If your preferred stock is cumulative, that means that every year you don't pay a dividend, this running total off to the side called dividends in arrears, it's just building up. And before you can pay a single dime to a common shareholder, you have to pay all the dividends in arrears to the preferred stock. And that's where this preferred stock kind of gets its name, is it's preferred because the preferred stockholders are getting their dividends before the common shareholders, so there's preferred treatment. And also in case of bankruptcy or they sell out of business or go out of business, preferred stockholders get a cut of the equity before anything goes to common shareholders. Common shareholders have the most risk, but they have the most potential return as well. So preferred stock, cumulative, know that we don't ever have to pay a dividend until our board of directors declares it, but if our preferred stock is cumulative, we cannot pay any dividend to a common shareholder until all our dividends in arrears are paid. Dividends in arrears is not a liability. It's not any kind of account. It's not recorded. Somewhere in the corporate minutes, it keeps track of these preferred stock dividends. Okay, so now I'm going to give you a minute to answer this one. Before a company can pay dividends to the common stockholders, the owners of cumulative preferred stock must receive what? Have an answer?
Not yet.
Okay. Do you have an answer? No. You think C? Okay. Okay, I got the answer C, and the answer is indeed C. Before a company can pay dividends to the common stockholders, they have to pay the owners, those cumulative preferred stock owners have to be paid all the dividends in arrears. So dividends in arrears are all the preferred stock dividends for the prior year and the current year dividend. So common shareholders cannot get a dividend until everything's paid up on the preferred stock. Okay, so if preferred stock is cumulative, that means we have to pay everything up to date before common stock gets anything. So that's part of the reason that preferred stockholders are willing to accept a lower return, is that they know that they will get some return before common gets anything. Okay, a share of 5% preferred stock has a par value of $50 and market value of $75. The owners of the preferred stock will receive a dividend of what? Have an answer? Okay, you say 250. Okay, what about you? Okay, okay. What about you? You think it's B? Okay. Okay, so a variety of answers. A share of 5% preferred stock. When you read about preferred stock, that percentage says this is the rate of dividend they're going to get. That dividend rate never changes, and their dividend never changes. So if I tell you their dividend never changes, the amount of their dividend never changes, are you going to use the par value to calculate it or the market value to calculate it? Yeah, because the market value is going to change, right? And I just told you the dividend will never change. So you have to use the par value. So to calculate a preferred stock dividend, you're always going to use the par value times the percentage. A preferred stock dividend will never change. If you base the preferred stock dividend on the market rate, it would change all the time, and they don't change. Preferred stock is a fixed rate of return. Okay, when 100 shares of $1 par value common stock are issued at $25 per share, paid in capital in excess of par value, common stock will do what? Okay, I'm going to go down here, going off camera. Okay, starting over here because you can hide over here with you. Okay, so what do you think? So let's do this. Let's break it down into little pieces. So I'm going to ask you questions that aren't up there. When we issue 100 shares at $25 a share, how much cash are we getting? $2,500. So what are we going to, cash is going to be debited, right? Okay, so if we were keeping track of this off to the margin, which I think you should, we would debit cash for $2,500. Okay? Then our common stock, I'm going to tell you this, our common stock will be credited for the par value times the number of shares. So we have 100 shares, $1 par value stock, so that'll be a $100 credit to common stock, right? Okay, so those are the two things we know. We know we have a debit to cash for $2,500. We know we have a credit to common stock for $100. Okay, so then my answer, so the other credit has to go to this long title account. We can just call it paid in capital, but no, that would explain after it what it is. Paid in capital will increase by how much? Has to be C, right? Yeah, has to be C because that's where my entry was. I would have debited $2,500 for cash because that's what I would get in cash. I would credit the $100 par value, the 100 shares times the $1, and then the difference is $2,400, and the big decision there is you basically had to pick off the $2,400. That's the only thing that would fit there. Okay. Okay. Next one, if stock is issued for an asset other than cash. So we're issuing stock. A lot of times companies do this when they're in startup mode. They'll issue stock for a building or in return for inventory or a piece of equipment. So we issue stock for an asset other than cash. The asset should be recorded on the books of the corporation at, anybody know this one? Do you know this one? You put market value, and that's a good thought. Yes. If we issue stock for an asset other than cash, we're recording that asset at fair market value. Okay, this next one. Wolverine Corporation issued 5,000 shares of its $5 par value common stock in payment for attorney services of $40,000. Wolverine stock has been actively trading at $20 per share, and this transaction would include what? So we have this list of choices. What I want you to do right now, and we're going to pause for a minute, I want you to write the journal entry for this. Okay, so let's write the journal entry for this, and I'll give you about 2 minutes, and then I'm going to walk around and get answers. Maybe a minute. 2 minutes is a long time. What are you going to do here? Okay, we've got three, I'll give you a hint, we've got three accounts. So when we issue stock, what do we normally issue stock for? Normally, why would you issue stock? If you're a company, why are you giving people stock? What are they going to give you in return? Cash, okay. But we said that we issued, so if we got cash, we would be debiting it, right? Okay, okay. But it says that they issued it in payment for attorney services for $40,000. So let me tell you that. So our first line of the journal entry is going to be to debit legal services for $40. So normally we would have debited cash for $40. You see where we're going with that? So we're substituting legal services. So our debit in this case is going to be to debit legal services expense or legal services for $40. Okay? Okay, so everyone knows we have this debit for $40,000. Now you're going to have two credits. Okay? So what's one of those credits when we issue common stock? If we went back to the homework exercises, the exercise 10 or 12 that we did, okay, and we have a journal entry where we issued stock down here, I believe, didn't we? Or did we? Not. Maybe we did not. The homework's all running together for me. Okay, so when we issue stock, let's do a credit. Let's reason through this. So we have a debit to legal expense. Our credit, common stock, does that make sense? For par value. So if we're going to credit our common stock for par value, what's it going to, so we have how many, looking back at the question now. So, okay, so we have how many shares of stock? 5,000. And what's its par value? So how much is our total par value? 25,000, right. So our credit's going to be to common stock for 25,000. Okay? So it makes sense so far. So we have a debit to legal expense for 40,000, a credit to common stock for 25,000. So what's the amount of our other credit? 15,000, right? So the only thing we have left now to decide is what that credit's going to be. Do you have an idea of what that will be? How's that paid-in capital account? It is. I'm telling you, the credit is for 15,000 to paid-in capital. So when we do that, then after we do our journal entry, so we would have debited legal expense for 40,000, credited common stock for 25,000, and credited paid-in capital for 15,000. The only answer here that fits is B, debit to legal expense. Okay. Okay, same question now, same data set, different question. Now it's asking on the credit side what this would include a credit to. So we should be able to answer that pretty quickly. So I'm coming back. So on this one, what's the answer on this one? This is the same journal entry we just did. So up here we had this, and we had that, and what was our other credit? Paid-in capital, yeah. And for how much? 15. So our answer is going to be B, yes. Okay, so this was part 2 of the last question. Okay. So again, we would be debiting legal expense for 40,000. We would be crediting common stock for 25,000, which is the 5,000 shares at $5 par value. And we would have a credit to paid-in capital for 15,000. I always abbreviate that as paid-in capital because we'll have paid-in capital in excess of par, we'll have paid-in capital for Treasury stock and things like that. But paid-in is the paid-in capital is the important part of that account name, and that's stockholders in stockholders' equity with a normal credit balance. Okay, now we have a little bit of extra time. I want to ask, does anyone have any questions about anything coming up in the next 3 weeks. So we're talking about schedule in general. Today's Chapter 10. Chapter 10 is not a bad chapter. There's some fundamental journal entries. We went over major points today. And then, yes. Oh, I have a question. Good. Wait a second. Hold on. I want to, whew. And by the way, do not want to leave yet. Okay, so here, ask your. We are doing Chapter 10 today and Chapter 11. So we're doing Chapter 10 today. We're doing Chapter 11 on Wednesday, and it is before you see the video problem. We're going to cover some. Next week we have Chapter 12 on Monday, and then we do not have class Wednesday because. And then the following week after Thanksgiving is our last week of class, and we have class on Monday. Chapter 13, I love Chapter 13, and it's a bunch of equations. It's how do you calculate this ratio? Divide by that, and that's how you get it. Chapter 13, very good chapter at the end. By the way, this is your preview. Finals available Sunday, Fridays. Cut off at 4 o'clock on. Now I've not published. Or listen to it later. Okay, I switched back to Bluetooth. Are you guys hearing me now? Okay. Okay. So, anyways, because you're listening to this, let me back up for a moment. The final is available Sunday through Friday of finals week. It'll cut off Friday at 4. I'm not putting up final exam information yet. I'm not there yet. But just for your own planning purposes. The Proctor Lab will be open on Sunday. So if you're in a face-to-face class and you're taking the exam, the lab will be open Sunday. This also applies if you're on the online section. You can also take it on Sunday. Now the reason I'm telling you this, so everyone has the opportunity, regardless of section, to take the exam on Sunday. You can take it on Sunday through Proctor U. You can take it on Sunday in the Proctor Lab. The reason that's relevant to everyone is if you take it Sunday, and this is a one-time offer, no excuses, it doesn't matter what excuse it is, but if you take it Sunday, you will get a 10-point bonus added to your exam Sunday night after you're done. Okay? So this is just to kind of give you an incentive to take it Sunday to get people out of the lab during the week. Yes? Okay. So will there be a big review session? We might do a review session online like we did the last one, but we don't have class time for that. But we'll do something online before then. But this exam, remember, it's not cumulative. It's just like the last one that it covers a certain number of chapters. I would also urge you to go to tutoring with Haley because she's working on preparing people for the exam as we go. This is not an exam that you want to cram for. You want to be working on it now. But again, and I'm not going to say a whole lot more about the final right now other than you have a one opportunity. If you take it Sunday, you will get 10 bonus points added to your exam score late Sunday night sometime, but there's no, that's your one opportunity. You'll take it in the lab if you're registered, and I'll get those hours out, but I'm not going to discuss a whole lot more about final right now. What?
Are you still going to?
Am I going to curb? I never plan ahead of time to curb an exam. So I would not ever plan on a curb. Okay? Okay, generally what happens on the final is a lot of people are in a situation where they need to do well on the final, so there's usually not a curve on the final because the grades are so high. Because you've got people that have to get a certain grade and therefore need to get a certain score. So yes. Okay. Yeah. But I'm not. We don't have the hours. I'm just saying that just planning on your calendar. The lab will be open some hours on Sunday. Last year we were open 8 hours on Sunday, and I was there for a good chunk of the time, and we had probably 250 people take it on Sunday. So, and I'll issue exam information in a week or two, something like that, and you'll get an announcement out about it, but I just wanted to get it on your radar so that you could make appropriate plans, because 10 bonus points is pretty significant. So if you can take it Sunday, I would urge you to think about doing that. And like I said, the lab should be open for at least 8 hours, but I don't know what those hours are. I would generally think if you wanted to plan, I'm pretty sure I will be there at 9 a.m. Sunday morning because we start pretty early. And last year, I think we filled up both labs by 10 or 11, and it was pretty significant number of people in a good way. I don't think anyone waited for more than 10 or 15 minutes on Sunday, but we were busy the entire day, and so and it is a 10-point addition that I make on Sunday night to it. Okay, so I just wanted to get that on your radar when you're planning out your finals week. Keep in mind you can take ours Sunday, get it off your to-do list, and get the 10 bonus points. So, okay, so what we're going to do now, and I would also tell you that we are probably going to do quite a bit of these the remaining days of the semester. We are doing we're doing the infamous, famous pop quiz, but it's yeah. Look at her. She emailed me. Don't worry. This one, easiest one you'll have all day. I need your signature on this yellow sheet. I will collect it, and I need your email address next to your signature. If you're online, you need to type your first name and your last name and your email address all in the chat window, and that's how you will get credit. So there is no, the last person to get the yellow sheet needs to hand it to me. I'll stand back here, but we'll stop. We're not going to stop. You can stop watching this, but we're going to keep recording it. But everyone needs to type in their full name, and you will have had to be here online. Okay? So get your first name, your last name, and your email address into the chat window. Oh, did they all? I can't see them. Okay. I know why. Yeah, you said. Okay. I was thinking no one signed in, but I see a whole lot of them. Okay. Okay. So then those of you in class, sign your name, your first name, last name, and email address, and then you are good to go. Okay? And I would encourage you to keep coming to class, because this probably isn't the last one of these, but you get full credit. We'll have the points up on My Accounting Lab within a few days. Okay, online, the window you have about 30 seconds to type your name, your first name, your last name, your email address, and then it's shutting down. So Haley, I want you to stop recording in 20 seconds now.